Hi, Cecil Robles here with your4xmentor.com, and today I kind of want to come to you with a little bit different of a video to give you a big picture analysis of the market, where we are now, where I see us heading in the days ahead, and exactly how you can capitalize on it. So I would suggest that you turn everything off at this moment and give your undivided attention to this. I believe that it can greatly impact your financial future and the significance of your wealth going forward from this point on. And I think that you can absolutely stand to potentially profit quite handsomely just by considering some of the things that I talk about today. So first off, what are we looking at here on the screen? Well, we're looking at what is known as the Volatility Index, or the VIX for short. And essentially, I have graphed it out here all the way back from 1998 all the way up to present day here in June of 2014. Now, I've also superimposed on the chart the Dow Jones Industrial Average, the NASDAQ, and the S&P 500. So the Dow Jones is the red line, the NASDAQ is the green line, and the S&P is the brown line on the chart. And essentially, what I want to point out today is the fact that the VIX is sitting near all-time lows at the moment. As you can see here on the far left, or far right of the chart rather, you can see that the VIX is sitting right here at negative 50%. And that means a negative 50% return from zero right here. And you can see, of course, that over since 2010, the stock market indexes have been cruising nicely up and have seen some very nice gains. What I want to point out, though, is that there are certain periods, certain crisis periods, where you see the VIX spike up and you see the market drop down. The other thing that I want to point out here on this chart is that anytime you see these things diverge, anytime you see the VIX diverge away from the market indexes, you can see here the market indexes are having nice gains here through the 2000s, from about 2003 all the way up until 2008. And then you could see that the VIX is, of course, down around the lows that we are currently seeing right now. Same thing happened here around 2000 when the tech bubble burst. You can see, of course, the NASDAQ was just screaming up to all-time highs right here. And then you can see, of course, that eventually came down and the NASDAQ came into line with the VIX once again. And then anytime you have these little divergence here where the VIX drops and the indexes go up, you can see that, of course, it's brought back in line. Here, once again, VIX drops, the markets go above the VIX, and then, of course, it's brought back in line. The VIX comes up, the markets go down. Here, same exact thing. Now, this was an extended period of time where we saw that happen until right about here in 2008, where we saw, of course, that change. We saw the VIX spike up enormously, and, of course, the markets drop enormously during that period. Now, we've had a pretty good run since 2010 with, once again, a couple of areas of divergence here, and then, of course, bringing it back into line, a couple of areas of divergence, then, of course, coming back into line. And that brings us to where we are right now. So we've had a tech bubble, we've had a housing and a credit bubble, and what I'm going to call the moment that we're in, or the time period that we're in right now, is the asset/monetary bubble. And basically what that means is we've been printing a lot of money, and so has the rest of the world. And that, of course, has generated growth in the economy, and more importantly, it's generated growth in the stock markets of the world. And as you can see here, of course, the U.S. stock markets, the indexes are up considerably from their low point here in 2009. And you can see that, of course, just by looking at the Dow Jones, just by looking at the S&P, and just by looking at the NASDAQ, you can, of course, see that in the price charts as well, how much of a bull run we've had in the stock market. Now, at the same time, you can see that volatility has come down to a low point. We're back to around the lows of the 2005 through 2007 period, when everybody was happy and things were flowing and credit was flowing and money was flowing and the economy was doing well. And then, of course, now you can see we're back down to that area. Now, why is that important? Why is this divergence so important? Well, the VIX is the volatility index. It's measuring volatility. It's measuring how volatile the markets are. And right now, there's not a lot of volatility in the markets. And that is because there is not a lot of investor fear. In other words, investors, Wall Street investors are saying risk is on. We're buying. Everybody's buying the stock market right now because it is on a bull run. There's zero fear in the market at this point. And that basically tells us that essentially people are saying or thinking, the mass psychology here is that this market is going to go on forever or can go on forever. And of course, that is the danger of mass psychology in the market. When we begin as investors and traders to say that this market is going to go on forever, that's the point that we need to begin to look for a change or a turn in the market. We need to be very diligent to pay attention to a change or a turn in the market. And so that's what this video is all about. Now, I want you to do a couple of things. I want you to pay very close attention to the VIX in the days ahead, and I want you to pay very close attention to the overall picture of the stock market, the indexes, the Dow Jones, the NASDAQ, and the S&P 500. Because in this particular bubble that we're in right now, we are going to see a correction. Now, I can't predict when that correction will be, but just looking back historically over the last 14 or 15 years, you can see that anytime we have a significant divergence between the VIX and the markets, you can see that we eventually get a correction. Now, we've had this divergence since 2012, since the beginning of 2012, and it's just continued to separate further and further. So we're 2.5 years now into this particular divergence. The last time that this divergence happened, starting around 2003, 2004, went all the way about to 2007, and then we saw a shift. So 3 to 4 years is what we saw out of this last run. Now, of course, we could get another year and a half, couple of years out of this stock market run. That's very possible. It's a big potential. But I want you to know that essentially we are at all-time lows in the VIX, which means that investors, they just don't have any fear that anything can happen. And that's always a bad situation to be in the market, because that's generally when people take abnormal risks. They begin to put all of their eggs in one basket, just like we saw in, of course, the credit bubble, and then like we saw, of course, in the technology bubble as well back in the early 2000s. And that's never a good thing. And we're seeing that right now. We're seeing that these markets are just exploding with growth, and yet the economy really is not generating that much growth. We're not seeing the massive growth that we should be seeing in the economy in order for these market returns to happen. So that has to mean that somehow, some way, it's being propped up. And of course, we as smart investors and traders, we know that that is in large part to the money printing and the monetary easing that's been going on with central banks around the world. Now, all of this is great information, but what can you actually do about it? What can you invest in? What can you look to invest in during this particular time? And when I say invest, I mean invest. I mean, look at it from the long-term perspective. What can you begin to look to invest in during this particular time in order to take advantage of what's coming in the future? Now, you need to be prudent. If you're in the stock market, that doesn't mean for you to sell all of your stocks right now. It doesn't mean for you to get out of the market right now. But you need to be paying close attention, because there will be telltale signs, just like there was in the early 2000s, just like there was in 2008, to get out of that particular market and to diversify into another market. That's what smart investors and smart traders do. That's what the big money guys do. They look for the right markets at the right time, and they invest in those particular markets. And then when it's time to get out of those markets, they get out of those markets and they invest in something else. So one of the things that you can look to invest in, of course, is the VIX itself, the volatility index itself. You can actually invest in the VIX a number of different ways, and you can do a little bit of research on that and find out how exactly you can do that. But just look at any time there was low volatility like we're seeing now, there were major spikes in the VIX. We can actually go to a price chart right now, and we can actually look at this. Okay, so we're on a price chart of the VIX, and you can see it's a candlestick chart. You can see we're right there, once again, right there against all-time lows. So the all-time low is just right under $10 right here. You can see. And right now, price is sitting at $10.98 or $10.98 right here in the VIX. So essentially, right now, risk to invest in the VIX is extremely low. But you need to do it with something like long-term options where you can get in and you can actually hold it for a period of time with a very tight stop loss. So if you just look here, you can see that the stop loss on this is going to be just over 1.2 or 1.3 if we put it below the lows down here from 07. You can see that it's going to be a very tight stop, but the potential is enormous. Even if we just got a spike back up here to the 25 area, and you can see that that's happened many times over the last several years. We've actually gotten all the way up to 47, 48 up here a couple of times, and we've seen spikes up to 30. We've seen spikes up to 30 right here, a little lower than 30, 25 right here, a little lower than 25, and then all of these above 20 as we get down to these low periods. So right now is a good time to look at investing in the VIX. All we have to do is have a couple of 2 or 3 weeks of just some enormous explosive volatility enter the market, and you can make a very sizable amount of money. You can double, triple, quadruple your investment on that, and even more. If we see the kind of volatility that I know is going to eventually happen within the next 2 to 3 years, and I'm putting that time frame out there because it may be sooner, it may be a little bit longer than that, but I would say within the next 2 to 3 years, we're going to see volatility like this again. It's going to come back up here into the 50, possibly even back up to where it was before, because we are building an enormous asset bubble right now, and so that eventually is going to have a day of reckoning. It's not going to continue forever, and more than likely it's going to be a lot sooner than later that actually happens. So once again, the volatility index is a good investment. There are a couple of others. Let's look at some others. How about the gold market? As you can see here, the gold market, we've seen explosive growth in the gold market from about 2007 onwards. And of course, once 2008 happened, and of course here is when the major crash happened in 08 around July, then into October, the third and fourth quarter of the year, then you can see gold start to take off, and it had that explosive growth that it had. And you can see that the whole time the volatility index is spiking, gold is going up. And then of course we've seen a correction in gold. But if I can blow this chart up, then you'll see where we're at right now. And we actually have what we call an inverted head and shoulders pattern. You have the left shoulder here. You have the head right here. And you have the right shoulder right here. And this creates what we call an inverted head and shoulders pattern. So here's the head, here's the shoulders, and then you can see the neckline right here that I've drawn on the chart. And essentially, if we get a break above that neckline, then we could see some massive movement in the gold market. Now, this is physical gold, so obviously this is more of a long-term investment, but we could see some massive explosive growth in the gold market in the days ahead. Silver, likewise, we could see some massive and explosive growth in silver in the days ahead. And this is a physical commodity. This is something that you can actually tangibly hold on to, and you can use it as barter or trade, or you can use it even as currency in the days ahead potentially. So once again, I believe that gold is going to make a comeback here, even though we're still at very high levels compared to what it's ever been. But I believe gold is going to make a comeback here in the days ahead. So gold, silver, precious metals, I believe we're going to see a comeback, especially here in gold and in silver for sure. Currencies, let's look at some currencies that during these last bubbles had some enormous movement in them. So here is the tech bubble. You can see this is the pound dollar. And this is basically right here around 1999 and then into 2000 when we saw the tech bubble burst. You can see the massive downward movement that we had in the British pound US dollar. So we saw dollar growth. Why? Well, because money's pulling out of the high risk investments, out of the stocks and into fixed income before it goes elsewhere, into fixed assets before it goes elsewhere. And then once volatility kind of cools off and we see the market begin to make a change, we can see here that we had enormous growth the opposite direction, right? All the way up until we had 2008 come around, and then in 2009, of course, right at the beginning of 2009, you can see we hit that bottom. But this was a massive, massive bubble that burst here during the credit market, and you can see just how much profit potential there was by shorting the British pound and buying the US dollar during this particular time period, and how quickly it happened, okay? Now, compare that with the volatility index that had explosive growth at that particular time as well, and you can see where we're heading right now. The British pound, you can see right here, I've drawn a line on the chart. Here is some resistance. Support always becomes resistance. Here is some resistance here that has yet to be broken through. Obviously, it's right there at that old support level, and so that has become resistance now. And if we see a correction in the stock market and we see the volatility index come back up again, we're going to see a major drop-off here in the Great British Pound US dollar. We're going to see an increase in the dollar and a major drop in the British pound. We could go back and test these levels down at 150. That would be about a 1,900 pip run right there. And that would be, of course, investing on the weekly chart. So all you have to do is look at your trades, look at your investment one time a week. That's the beauty of it. This is more long-term type investing. This is not day trading. This is not swing trading. This is looking at something a little longer term. And you need to have long-term stuff, you need to have medium-term stuff, and you need to have short-term stuff that you're doing in order to grow your portfolio accurately. So this is something that you can look at in the long-term realm here. Let's go ahead and look at another chart. Let's look at the pound yen, and we'll see kind of the same thing that happened or that transpired here. We can go back to the tech bubble, and you can see right here around 98, 99, you can see that major drop in the market. Then here in the 2000s, another major drop, and then finally it started to correct. And this was during the period where we had really what we call interest rates. This was during the credit swaps and the derivatives time period and all of that stuff, where we saw the interest rates in Britain at very high levels and the interest rates in Japan at very low levels. And you can see, of course, that created what we call the carry trade, and that lasted for several years here, where we saw a nice run in the Great British Pound Japanese Yen. And then, of course, 2008 came around, and you can see the massive, massive drop that we saw from the end of 07, really, and then of course in 08 when we saw the massive drop happen once again from the credit bubble. You can see just how many pips there were on the line here, from 210 all the way down to 120. So just a massive, massive, massive number of pips, 9,000 pips right here in the making, just in a very short period of time. That was in just a few months period of time. And those are the kind of trades that you can look to make. 9,000 pips with very small risk here, and the ability to add on a number of times in this particular scenario or this particular case. Now you can see that since 2012, we've kind of found a bottom in this market, and you can see that it's rallied back up and it's kind of got a nice smooth trend going up. Well, when volatility comes back into the market, what's going to happen is this is going to drop off again. And even if we just retested these lows here down at the 115 area, these lows that we had reached in 2011, 2012, even if we just tested these lows again, price is currently sitting at 173, could go up a little bit higher, all the way up to 195, 198. And then to drop back down to the 120 level, you're looking once again at about 6,000 to 7,000 pips of profit right there. So these are longer term things. This is something to look at. But once again, I want to bring your attention as we wrap this up back to the volatility index and just show you how much divergence we have here, so that you can see where we're heading Anytime that happens, once again, the market always has corrected itself. Anytime there's that big divergence, what happens? The market comes back. Big divergence, volatility shoots up, the market comes down. Big divergence, volatility shoots up, the market comes down. Big divergence, volatility more than likely is going to shoot up through the roof, and the market is going to come down. So somewhere back up into this range, these previous highs that we had here, about 38, 42 level, right around there, that would be a good target if you're looking to do some kind of trading here on the volatility index as a long-term play. So I hope that helped you. I hope that this gives you a big picture view of the market. And this isn't meant to put fear in you, but it's meant to make you cautious. It's meant to make you prudent in your investments. And hopefully you will be paying attention to this a lot more in the days ahead.